Welcome to this new episode of Champions with Checkbooks. This is an initiative by the Women in Investing Network, a 500-member community of women investors in India. Every time I speak with a guest on this podcast, I check this number, and it just keeps on increasing. I'm Sapna, representing the WI network. Today we have our dear friend and long-time WI member as a guest, Lavanya, partner at Trifecta Capital. She has 18 plus years of experience across growth equity investing and investment banking. Over this time, Lavanya has seen the entire cycle from investing to exit across multiple portfolio companies. We will unpack a lot of her learnings from exits, which is the holy grail in the venture capital world, driving actual cash and cash returns to LPs. Welcome to our podcast, Lavanya.
Thank you so much, Sapna. It's been so long since I first met you at Goldman. We share an alma mater in common, and so wonderful to see your evolution as an investment professional. Thank you so much for having me.
Thank you. I'm really excited for our chat today.
Yeah, me too. 500 plus. Our tribe is like so much in the news these days for its strength and its vibrance. So wonderful to be part of.
Let us start with your journey. So take us through your journey of becoming an investor and your experience of investing across stages, cycles and geographies.
Yeah, sometimes make me sound way cooler than I am. But I'll try to give you a quick arc of my journey to date. I grew up here actually in Bangalore, this lovely city where we're recording this wonderful conversation. And Sapna had the privilege of going to Wharton undergrad, post which I got a summer internship at Goldman Sachs in New York. This was, dream internship for somebody from Bangalore who had never left the country before and never left the office that summer, and so spent the 2 years post graduating with my degree at Goldman in New York as an investment banking analyst. And after that, like every good analyst, I wanted a job on the buy side, and I had the good fortune to get an opportunity to join SPO Partners. At the time, SPO Partners had 10 people and $8 billion under management. I was like, that's an amazing per-person AUM. And I'm sure there's a lot I can learn from this group, this very talented group of people. And the SPNO were all still active general partners in the fund at the time I joined. So it was a beautiful apprenticeship. I was there for 2 years. And something I can truly trace my lifelong, passion for investing to, those 2 years and the founding partners of that fund.
So you started with growth stage. Was that growth investing private?
Good question. SPO was structured as a hedge fund. Okay. So you could do whatever you needed to do to make money. And the founding partners had been investing together for 30 years. And their IRR over that period was in excess of 30%. And so they done very well, and so they had the privilege of doing private, public, debt, equity, distressed, real estate. So there was a lot of flexibility. There was also a lot of AUM. I think the way I would best describe, if you were to crystallize that strategy, was deep value-focused investing. And so a little bit different than the next phase of my career, which, post my MBA at Stanford, I came back to India to kickstart, which has been in the growth and, buyout space. Yeah. And so since 2010, when I returned to India post my MBA, I've been very focused on this market. And, we're fortunate to be in one of the largest economies of the world, growing at high single digits, right? 7.5%, 8% is, an amazing sort of growth for the times where there's gloom and doom globally. Yeah. So the last decade and a half has been solely focused on the growth stage. And so I came back as employee number 3 to Goldman in the private equity business. I was there for a decade. Yeah. And then joined Trifecta Capital almost 4 years ago to kickstart our growth equity investing effort. Up until that point, Trifecta had been a market leader in venture debt, and we wanted to start our main growth equity.
Okay. With that, let's talk a bit more about Trifecta Capital. Yeah. So what sectors, what stage, check size you invest? And for our founder audiences, what kind of founders can approach you? Is a venture debt investment from Trifecta precondition?
Great question. Venture debt from Trifecta is not a precondition. Okay. In the first fund we raised, about 2/3 of the capital has gone to relationships with founders we've had either through venture debt or our treasury solutions business. And 1/3 has been just exciting companies we found in the open market. And so the reason we set up the growth equity fund was really because we perceived that there was a growing gap in the market as early stage venture was seeing success. Large companies were getting built in digital India. And we felt there was, of course, private equity money, sovereign wealth fund money, and some crossover and hedge fund money that was investing in the growth stage, especially the 2020-2021 vintage. But we felt there will be time as this ecosystem matures for domestic managers who are deeply entrenched in this ecosystem, who have strong networks, good perspectives on where the next crop of growth stage venture is going to be. And so that was really the thesis with which we started the growth equity fund. We had a 150 plus company portfolio on the venture debt side, which is of course fertile fishing ground for me on the growth equity side, but that's by no means the only pond we're fishing. So, all types of founders are welcome. We're excited to meet with all of you. And, like a friend of mine said when she was asked what food do you like, the only criteria is that it has to be good. Right?
Okay.
So, same criteria for founders.
Sure. And in terms of check size, stage?
Yeah. I think, Sapna, given the ecosystem evolution we're seeing, right? Ventures, little over 15 years old as a truly mature asset class in this country. We feel anything series C and beyond, up until the truly last private round, prior to a liquidity event or prior to finding a permanent source of capital, is the sandbox we've drawn for ourselves. We have flexibility around these because what could look like growth stage for SaaS could be very different from what looks like growth stage for B2C brands versus a consumer internet platform. So metrics-wise, it's hard to be precise, and funding rounds are also now taking on different lives of their own. But I'd say loosely defined CBC to truly the last private round. And in terms of average check size, we've done around 100 crores or 15 million on average per investment. And we've been a small part of a large round, we've been a large part of a small round. We've been the only participant in capital that was needed maybe to finance an acquisition or an organic growth vector. So all of the above, and we're happy to do secondary as well if there is a churning of the cap table that is sensible and
That's a lot of variety.
Yeah.
Okay. I think one of the highlights of this discussion I really wanted to talk to you about is, exits.
Yeah.
So exiting a business and seeing return is the ultimate aha moment for investors.
Yeah, absolutely.
What are your learnings from exits, that you've seen in your career? And what would be your advice to investment managers for maximizing their exits and returns?
Sure. No, I mean, it's really nice to be able to talk about real exits because there was, one point when I was earlier in my career at Goldman, we were very much in the building out of the portfolio phase, and, India has often been referred to as a black hole where a lot of money comes in and not a lot comes out. Yeah. But if you look last year, right, there were $25 billion worth of VCP exits, which, by any measure is a very substantial amount of capital return. And so I think the time has come for a big crop of invested companies to start seeing liquidity. And we're at a very nice phase in that journey where the IPO markets are cooperating. There are a growing number of global strategics who are looking to India as an investment destination and where they want to be the consolidators. And we're also seeing large private equity and sovereign wealth funds that want to own these businesses for the long term and who see immense cash flow generation potential even from the new economy. Yeah. So just personally, right, I was fortunate to have been, in one seat for 10 years at Goldman, where you do something long enough, you also give it time for the cycle to turn and to see success. And so actually I was fortunate to see 3 substantial exits in my career there. When I was at Goldman, we invested about $500 million and pulled out $1 billion in exits over that 10-year period. So I saw a fair bit of that. And I've seen a good flavor of exit activity starting from, PBS Logistics, where we invested with the thesis that this would go IPO in 5 years. 5 years came and went, a bunch of global consolidation activity happened, the business multiplied wonderfully from both a revenue and profitability perspective, but was not ready at that moment in its journey to go seek a listing. And so I actually spent 9 months of my life, almost my entire pregnancy actually, negotiating a private exit when CDPQ wanted to come in and put in their first private check in a direct investment into the country. And so we made almost 5 times our money on that investment, but it took 8 years in total. And it was not in the form we had envisioned, right? If you go look at our investment agreement, there was definitely an exit waterfall, IPOs on top of that, and 5 years was the time. Yeah. So I think my biggest learnings from that experience, for example, Sapna, in India it's very difficult to time exits precisely. So if you have the ability to wait, especially with your winners and higher quality assets, you can, I think, manifest a much more favorable outcome for your LPs. I think if we had tried to forcibly exit in 5 years the way we had originally underwritten, we would have made a very lackluster MOIC, because at that time, like I said, the business had doubled in scale in a short period of time because of an acquisition. There were a lot of synergies that had to play out for that to show up in the margin profile. And so that patience really helped us on both a wonderful multiple of money and a pretty good IRR. So I think patience, especially when you have multiple constituents that are all sort of in the mix, was something I learned from that. I think the second thing is you can't sit back and be passive about your exit strategy, right? I think if we had just hope that something will happen and it's a good business, it's growing nicely, it's profitable, we get our money out, I'm not sure we could have got the kind of return we saw. So I think those were some of my learnings from, and private exits take a very long time, especially if it's a large check for somebody, especially if they aren't as familiar with the market. But then there's a nice outcome that you can get for yourself if you can get a differentiated pool of capital into the mix and over that. So those were some of the learnings. More recently, right, our first portfolio company at Trifecta Growth, Ixigo, which actually I was chasing that founder Alok when I didn't even have a fund. We actually had a pre-existing venture debt relationship with Alok. I had met him at Goldman as well when he was a meta search platform pivoting into an OTA. So Alok and us had a lot of institutional history, and personally I had also seen him execute over a 5-year period when I was tracking that business. So I really wanted to invest in his business. My fund wasn't ready yet. Fortunately, we had an opportunity to invest in the round because we raised money at a time when India tech was really in favor. And so that was really our first investment from the fund, and that company went public a couple of months ago and has seen a very nice appreciation since IPO as well. But again, there was no rush to glory. Alok wanted to list his business a couple of months after we invested. He even had SEBI approval, but then the markets rose globally. India tech fell out of favor. A couple of the nicely performing listed stocks corrected very dramatically. And so collectively, we felt that wasn't a good time. And so despite the company being ready, the company being profitable, the company having SEBI approval, we collectively as a founder and investor group felt the timing. And so the business continued to grow, and when the markets opened up in this post-election window, we were ready, and the founders saw a very nice milestone to cap off a 17-year journey. And of course, nothing ever stops, right? They still at it. They just signed a large contract with PhonePe, they're hustling, they are now building out the hotels piece of the business. There's a nice GenAI layer that's being built on top of the core travel tech offering for trip recommendations, for superior customer service. So the fight never stops for the founders. But I think a very nice validation of what has been a very arduous journey through multiple droughts in equity funding.
The point you mentioned around you have to fight for exit, you have to prepare the business for exit. From a founder perspective, are there any challenges you've seen, meaning founders resisting that exit or preparing the founder for an IPO? It's a very different journey after that. Any trends you've seen there, and any founders who are at the cusp of thinking about exit or thinking about an IPO, anything that you would want to advise to them?
No, it's a great point, because I think the cadence of reporting and scrutiny as a public company is very different, right? And I'm not saying you can't invest for the long term as a listed company. There are multiple listed companies that But I think the public markets disproportionately reward predictability, right? And if you're truly in the investment phase of your business and you feel that this is the land grab opportunity, I want to go and get this customer because I truly believe there's a very deep lifetime value unlock that's possible. And this is the sensible time to go make that investment. Then maybe that is not the right time to go and be scrutinized as a public company, right? So I think there is business model maturity and then there's founder maturity, right? Because you can't behave in a manner that is inconsistent with a predictable growth path for your business if you're a listed founder. Yeah. And I think on the private side, and rightfully so, founders may have been used to multiple pivots over what could have been, a very tough, steep climb to product market fit. And so it's difficult as a public company founder to get up in the morning and say, oh my God, I had a wonderful idea, let's go invest meaningfully to make this a reality, right? I think these decisions need to be much more deliberate because you now have a very different investor base that has a very different return expectation profile as well. Yeah. And the risk-reward trade-offs continue to change at every piece. Yes. Where you are in very early stage, the power definitely applies, right? And arguably it stays in public markets as well. Yes. But technically it shouldn't in the same manner. And so I think the biggest advice I have for founders is, take the time to prepare yourself for that listing and make sure that you are convinced and ready that that is the right step for your business. Yeah.
And as in private investors, it's also our job to sort of help them.
100%. 100%. Right? Because there have now been a source of founders who've been a source of mentoring and advice and guidance to the ecosystem. Yeah. But it also hasn't been in the kind of large numbers you see, for example, in America or China or some of these more mature venture markets. It was still going down that curve.
Yes.
And I think the learnings are coming, right? It's like present continuous.
That's true. So now moving down the sort of time scale here,
yes.
When you're investing in a founder at Series B stage, C stage, when you see that journey from Series C to a pre-IPO or an IPO, what are those top 2-3 mistakes you've seen them making, during that time, and what is it that you feel they can learn from mistakes of other founders?
I think, look, first of all, I just have so much respect for the founder journey. I mean, it is 100% all in, like day and night, right? And so much volatility founders have to personally and professionally endure and their families as well. So I'm hesitant to point out, mistakes very directly, but I think there are 3 areas where I feel it's easy to falter. One is hiring either too late or too early. So let me try and give you an example, right? You're a youngish business, you need to be dynamic because you're just navigating product market fit. If you get a bunch of very heavy hitters from very different old economy DNA, for example, yes. Right? And I've seen this in some portfolio companies. You may not be ready to absorb that talent today. And I think therefore, but if you wait too long, then you may lose out on the growth opportunity because you don't have the muscle you need to help you navigate those paths. Yeah. So I think it's a very fine line. And it's also costly to make these hires, right? Not all of them are only there for the equity upside. Some of them will also want a certain salary and cash compensation that they've been used to. And so I think this hiring too early, too late, or too late is something I've seen a lot of leaders struggle with. And there's no perfect answer, but I think the founders who've done it well have also interviewed very intentionally for DNA, right? And making sure that even if that person is institutionally trained in the bluest of blue chip companies, that they have the hunger and the resonance with what you are trying to do as a founder in your mission. And maybe that helps to align over the periods where there might be some dissonance between where you are in your institutional journey and where that person is ready to take the business. Sure. Right? So I think that's one. The second, and this is something I learned from one of my mentors and bosses at Goldman called Sanity. He always used to tell founders, he's like, the business needs have to come first and the capital needs, will align to that, right? Don't solve for capital first and then figure out what to do with it, because then you're just optimizing for the next fundraise. You're not building to last. And capital is fickle, right? We will decide what we want to do based on 100 variables. But you as a founder need to build your business to last. And so I think that is the second piece where I've seen, some founders, money is available. There is one school of thought which says if money is available, just take it. They take a lot of money and then she or he is now pressurized to show a lot of growth because you raised a lot, you diluted. So I think being really thoughtful about what does this business need, and then let me get the best source of capital for that need. And raising a little ahead of need is always a good idea, right? Because we know funding winters come quickly, they last long, it's painful. But I think being careful about what that money comes with and what pressures it brings is also, I think, one place I've seen founders struggle and fall and, then have to maybe even reset the entire cap table because of the missteps that were made as a result of that pressure to grow at all costs. And I think the third thing is really, in some verticals we've seen India is not a deep enough market for a large business to be built, right? So you see founders start to be all things to all people. They may have started out with a really sharp, mission statement. This is what I want to be. And then you reach a certain revenue milestone and then you're on a plateau. Yeah. And then you're trying to find that next vector of growth. And I'm not saying that's a bad thing. Many businesses have grown encircling the customer. Many businesses have grown adjacently. But I think, is the org prepped for that kind of growth? Right? And do you have the capital for that kind of growth? Because you may have seen a lot of success in an asset-light form, but suddenly you're now pressurized to go make a bunch of investments. Are you ready for that? Right? Is the org ready for that? Is it a cap stack you have here for that? So these are the three broad categories where, and investors are complicit in this too, right? It's not purely founders.
That's true.
But I think hiring, raising too much or too little.
And the kind of capital as well.
Absolutely, the kind of capital, what that comes with, and then, how you choose to chase the next wave and leg of growth. I think
those are really good insights. And also a reminder for everybody. Sometimes you need that reminder to just keep focusing on the right things. Always. You've also sort of invested through the cycles. You've seen many cycles. Are there things that you keep reminding yourself of?
Yeah.
As an investor, sometimes we get swayed by the markets are up and the markets are down. How do you keep sanity in the cycles?
At least one thing I keep repeating to myself is it's never as good as you think, it's never as bad as you think, right?
Sure.
And it's true because I think there are points in the cycle, especially in venture land, where you can feel like you're swinging between hero and zero, heroine and zero. I think the important thing is we have to continuously be truth-seeking. So if you've taken a decision as an investor and it's not playing out, right? We have to acknowledge to ourselves, hey, we did this, it's not working. We have to come back to the table and figure out what is next for this business. Right? It could be, a new initiative they did, it could be rethinking the entire business, it could be this margin profile we thought would play out is just not showing up because of X, Y, Z reason. How do we tackle that? But I think in the good times and the bad times, being able to keep the business separate from its valuation and all the other noise surrounding it and say, okay, the market may not be rewarding this business today, but do I still believe in this business? Is it fundamentally sound? If not, how do we strengthen it? Or how do we get it a home? Right? I think that is what I keep reminding myself of in the tough times. And in the good times, I think we have to be disciplined about taking money off the table. You asked me, right, about exit discipline. I think it's really hard to cut your losses when things are bad and to sell when things are going really well. Because there's a lot of temptation to keep going.
Yes.
Because you're like, oh my God, I love this team, I love this business, it's growing so nicely, it's compounding so well. But if you had an investment thesis and an underwriting case and you met it, I think it's important to come back to the table as a partnership and have that discussion. Okay, we thought we'd do this, we have done this, maybe it came sooner, right? In some cases, you do better than you think. And in some cases, of course, you do worse and then you struggle and you figure your way out. But I think there's money to be made in all types of environments. We never made money not investing, right? And so I think there are, of course, vintage-related characteristics. There are some vintages that by definition perform well, like this vintage. We all, I think, will perform really well because you are getting high-quality, resilient businesses. Maybe not cheap, because in India, you tell me, Sapna, have you got good and cheap?
Never.
But on a relative basis, right? Cheaper than
less expensive.
Less expensive. So I think vintages like these lend themselves to good returns, but we truly believe that through cycles, right, you can find strong investment opportunities. And so
that's a good reminder, I think, for all of us as investors. Okay, so with that, we've come to the last section of our podcast. This is a rapid fire round.
Oh my God!
Are you ready?
No. Okay, fine.
All right. So, it's a mix of questions where we're trying to get to know you better, not just your professional side, but also the personal side of it, and the fun side of yours. Okay. So, whatever comes to your mind first. We start with related to investing. An investor whose work really inspires you.
John Scully, the founding partner of SPO Partners. So I'll tell you why also quickly. I know it's rapid fire, but he was 62 at the time of this incident. He called me at 6 a.m. and he was like, "Wow, I invested in railroads 2 decades ago, and I feel there are some parallels to certain internet businesses today in terms of enabling pipes, and I want to talk to you about it at 8 a.m. in office." I'm like, that kind of passion, and of course the track record, I told you, 8 billion, 10 people, amazing, yeah. But also just the passion for continuously updating your own schematic, looking for new trends, learning from young people, asking them for their opinion. I think, he was one of the all-time greats, and then, continued to mentor generations of young investors.
Your personal and professional shout out? Anyone who you want to call out as a mentor, sponsor, champion?
Yeah. So there were 3 people at Goldman who I felt really made my time there so sort of wonderful. There was Sanjeev Mehra, who was the vice chairman of the group. There was Pat Kogan, who was the senior most woman in the investing division, and sort of just such an inspiration. I'm sure for you as well. And then my immediate boss, Ankur Sahu, I think this triumvirate really sort of gave me so much opportunity, so much exposure, and so much room to run and be creative about how we cover India. And then, outside of the ecosystem, there's been so many sources of inspiration, including, Peter Ginsberg, who I look to every day for personal inspiration.
Okay. If you weren't an investor, you could be?
Either a doctor.
Oh, okay, that's interesting. The best founder, sort of first presentation you've seen, or love at first sight?
Oh my God, okay. No one holds this against me, but Adit of Zepto. So my partner Rahul Khanna and I met him when Adit had literally not even dropped out of Stanford. He had just decided not to even go, right, during COVID. And I'm like, and he had started Zepto, and they had this promise that we will deliver groceries under 10 minutes. And so many had tried and not succeeded in that space. And so we went in, skeptical, but I came out such a convert. I'm like, that is wise beyond his years, has such a deep first principles approach, coupled with just insane ability to attract talent and execute. That I noticed that very early, and I continue to be a power user of Zepto, and we've given them venture debt as well.
Yeah. So, and they're doing so well now.
Yeah.
A book you read recently that you want everyone to read?
Okay, so The Covenant of Water by Dr. Abraham Verghese. Oh my God, the book made me laugh, it made me cry, it just moved me, it made me think of so many people in my family. It's also set in Kerala, where my mother is from, and so it also had some personal resonance. But not just me, Oprah said it was among the top 3 books she's ever read in her life. So, sources way wiser than me have also endorsed this book, but I just absolutely loved it. It was delightful.
So the next book you pick up should be this one. Okay. A fun fact that very few people know about.
So when I was 10 years old, I understood the concept of what a twin was. And ever since, I've always wanted twins. Mm-hmm. And in 2016, the universe heard my call and decided to give me twin boys. And so my husband always says, be careful what you wish for, because dreams can come true. But I'm really blessed to have Tahan and Shivan in my life.
Wow. Okay, thank you so much for sharing that with us. So with that, we will close this episode of Champions with Checkbooks. It's always fun to speak with you, Lavanya. It's towards the end of the evening and I feel like we're just starting.
Thank you, Sapna.
Thank you so much for sharing your insights with us.
Thank you so much. And I really love being part of this network. I love the work you're doing. I've listened to some of your other podcasts. They're fantastic. And so thank you so much for having me.
Thank you.